As earnings season kicks off this week, Bank of America Securities raising its full-year S&P EPS forecast by $20 to $185. That's up 32% year over year. But the firm telling investors to curb your enthusiasm as the S&P year-end price target remains unchanged at 38,000. Of course, as we stand, we're at 4,125. Joining us now to explain why, Bank of America Securities Head of U.S. Equity and Quantitative Strategy, Savita Subramanian. Savita, good to see you. Thanks so much for joining us.
Nice to see you.
So you've
Thanks
got
for having me.
A number of reasons why you're kind of cautious on that year-end return for the S&P 500 from here. The first of which grabs my attention most of all is just sell-side indicators. Talk us through that.
So the sell-side indicator is a sentiment indicator we've been tracking for decades here at Bank of America. And it's basically just looking at what Wall Street strategists are telling you to allocate to equities in your overall portfolio. And what we found is that this is, if you take the average of all of these allocation recommendations, this ends up being a very contrary indicator of what you should actually do with your money. So historically, what we found is that when there's lots of good news swirling around and everybody's really bullish and it looks like stocks are going to go up forever, and allocations grow very extended, those are better times to sell because chances are all of that good news has been priced into the market. And today we are at similar levels of very stretched allocations to stocks. In fact, we're just 1 percentage point away from a sell signal from this model. And I think what this underscores is the fact that there's not a lot of reasons that doesn't feel like there's a lot of reasons to worry today. The economy looks great. We've got this recovery in profits. We've got IPOs of esoteric instruments. It just feels like a good, great environment. Stocks have been going up pretty nicely for the last 12 months. In fact, we've seen record levels of returns over the last 12 months, and I think what that tells us is that the market is more likely to disappoint in the opposite direction of where everybody is really thinking it's going. So that's one warning sign to us that things are looking pretty toppy.
So, Savita, what do you do then in that environment?
Yes. So what do you do? So there's always something to buy. And our view is that while the S&P 500 might be pricing in a lot of the good news, there are pockets of the market that are definitely still trading at relative discounts. And I would stick with cyclicals. I would look for CapEx beneficiaries, since we're hearing a lot more about potential infrastructure, potential CapEx boom, areas like industrials, even financials, which have worked reasonably well over the last few quarters, but there's still a lot more upside, we think, in terms of relative gains. Now, I think what's interesting is that despite the fact that this year looks very different from last year in terms of, reopening the economy, we have a new administration, we could potentially see tax rates go higher rather than the cuts we saw a few years ago. Investors are still very similarly positioned to this growth and tech bias that they've had for multiple years. And I think that is slowly being shaken out by this value rotation. I would stick with value. I would stick with cyclicals. I would stick with industrials, financials, even energy. I think there's more to go. Small caps, I think there's more to go. People look at this violent rotation as though it's been a really long time that value has been outperforming growth. But actually, it's only been a couple of quarters. So we really need to think about it within the context of a big recovery, potentially a big move on the cyclical recovery frontier, and really look for pockets that are undervalued today. And we're still finding a lot of them.
Well, it's a trade that's working today, for sure. Russell 2000 up 1%, S&P lower. Savita Subramanian, thank you very much for a quick hit on your note today. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.